In this video, I'm going to look at what a tax-efficient investment looks like in the Australian tax system and how you can compare your investment choices with tax in mind. Generally, Australian listed companies pay high dividends and often maximise the use of franking credits for investors, which is unique to Australia. Other companies focus on growing their earnings and use their returns to fund business growth, reflected in the high share prices over time, instead of paying dividends. These investments could benefit from another tax incentive in Australia called the 50% CGT discount. But which is better, franking credits or the 50% CGT discount? The answer may surprise you, so let's get started. To keep it simple and easy to compare, I won't be covering common tax strategies like 1. Negative gearing, or 2. Investing in the lowest income spouse's name, or 3. Using different tax structures like superannuation funds or family trusts. Instead, I'm going to focus on just one consistent tax rate. So my focus will be on the tax payable of an individual Australian resident already on the middle income tax bracket of 34.5%, including Medicare levy. This tax rate will cover the higher level of tax for most of my YouTube audiences, but it's important for consistency. I will also be covering only listed investments as they are simple and transparent to compare. Please note that this is not investment, legal or tax advice. Instead, this is an explanation of how the Australian tax rules apply to dividends and capital gains at a consistent tax rate. So is it more tax efficient to receive fully franked dividends? Let's look at an example of two popular Australian investments. AFI versus VAS. I will be getting my data using the share checker function on ShareSite that you can find here in the home screen. Now, if I invested $10,000 on the 1st of July 2022 in AFI, the ShareSite report says I would have bought 1,315 shares at $70.07 each for a total outlay of $9,994. Now, if I add this investment to ShareSite like this, I can figure out how much income and franking credits I would have earned for this one investment for 1 year. ShareSite tells me for the 2023 tax year, AFI would have paid out $328.75 in dividends that were 100% franked. So a quick recap, franking credits are taxes paid by the company on the income it earned. Since AFI is a company that receives incomes from its investments in other companies in its own name, it is required to pay company tax at the flat rate of 30% for large companies. The franking credits paid by AFI are then passed on to its investors of AFI when it pays a dividend. The whole purpose of franking credits is to avoid double taxation on earnings that the company pays and then what the shareholder receives from dividends. This is very tax efficient and is unique in the investment world. Next, if I invest another $10,000 in VAS, an index tracking trust run by Vanguard, on 1 July 2022, using the ShareSite tool, I would have purchased 123 shares at $81.17 per share for a total cost of $9,983. As VAS is an ETF, or an exchange-traded trust, it doesn't pay company dividends per se, as it is not a company like AFI is. Instead, in 2023, VAS paid out a trust distribution to me of $341.61, since it is a trust. Trust distributions are not dividends, which is a common misunderstanding. A trust distribution looks a lot like a dividend from AFI, and is paid directly in cash to my bank account as a lump sum each payment cycle. The only difference of a dividend and a distribution appears at tax time when you are filing your income tax return. This is because a trust distribution is made up of different components for tax, such as franked Australian income, unfranked Australian income, capital gains, foreign tax credits, deferred income, and so forth. This means that you need to show this income in different sections of your tax return. I have created a video on how to complete your tax return when you have received a trust distribution step by step. I will include a link to it in the description of this video. In comparison, dividend income is shown in just one section of the tax return with franking credits shown near it, like this. Most Australian dividends are pre-filled in your Australian tax return by the ATO by mid-July usually, whereas ETFs are not usually included in your tax return pre-fill until at least mid-August, since there are many differences between what is paid in cash to you and what you need to include in your tax return. In terms of tax compliance and the time to prepare your tax return, receiving a dividend is much easier, and you usually don't need to wait for the pre-fill to complete your tax return. Now, if we compare the dividend paid by AFI with the trust distribution from VAS, an interesting picture emerges. Using ShareSite's tax reporting features, I can see that the dividends paid by AFI is less than VAS. However, AFI provides a 30% franking credit of $141, making my total taxable income $469 for AFI. Taxable income is the sum of the dividend of $328 paid in cash plus the $141 of franking credits. If the taxable income of $469 is assessed at a tax rate of 34.5%, then gross tax is $153 before franking credits. However, we can reduce this tax by using the $141 of franking credits received. This means the total tax payable on this income is only an extra $12. Now, VAS paid a slightly higher trust distribution in cash of $342. It also distributed franking credits of $129 since it invested a lot in Australian shares, just like AFI has. However, the trust distribution is not fully franked at a rate of 28% compared to 30% like the AFI dividend. Now, in your tax return, your taxable income for the VAS distribution would be $465 after adding the franking credits and then subtracting the $7 of the non-assessable component of the trust distribution called a tax-deferred amount. A tax-deferred amount actually reduces the cost base of the investment, which will result in a tax event when you sell the investment later down the track. Also with VAS, there are no capital gains distributed in the 2023 VAS payment. So this avoided more complex CGT calculations, which I've covered in another video, which I'll include in the link. So the gross tax payable at the 34.5% marginal tax rate is $151. However, this time we are subtracting less franking credits of $129. Also, there was some foreign tax credits distributed of $1, which also lowers the tax bill. All up, we must pay $21 of tax. So this year, it appears at first glance that VAS was less tax efficient since my tax bill is higher. However, another way of comparing the tax efficiency of investments is comparing the after-tax return on investment as a percentage. In my example, even though AFI distributed more franking credits, it has a slightly lower return on investment after tax at 3.16% versus 3.21% for VAS. This is simply because VAS had paid a higher distribution in cash of an extra $14. Why did VAS distribute an extra $14 when it mostly invested in the same Australian shares as AFI? Well, there are many variables and there is no simple answer. One simple explanation is that VAS passes all the income onto its unit holders 4 times a year, as it has no other option. In contrast, AFI pays out the maximum dividend that it is fully franked as a company policy. In contrast, AFI pays out the maximum dividend that is fully franked as company policy. If AFI has received more income than it has paid tax on, at the 30% rate, it will retain that income and likely will pay it out in the following dividend period when the company has built up more franking credits to pass it on. So essentially, it could be just a timing difference. That leads us to our next scenario. Is it more tax efficient to focus on shares that pay dividends each year? Or is it better to invest in high growth investments that pay fewer dividends, who reinvest in the company itself? Before we do that, if you're finding this video helpful, please do me a favor in pressing the like button and consider subscribing for more videos like this. It really helps me to make more videos and supports my channel. Thank you. For this next comparison, I'll be comparing a popular global stock ETF called IVV, which rarely distributes franking credits. I will compare this again with VAS, which has a high amount of income paid out with franking credits. So is receiving a return in investment from capital growth more tax efficient than receiving annual income? To compare, I'll be looking at an investment time frame of 10 years to allow capital growth to occur. If I invested $10,000 in IVV on 1 January 2014, I would have bought 48 shares at $207.10 per share, with a total cost of $9,940. If I sold the investment in IVV on 1 January 2024, I would have received back $32,004. Using this ShareSite performance report, during that time, IVV would have paid $3,964 of trust distributions to me with no franking credits. Now, if I purchased $10,000 of VAS on 1 January 2014, I would have received 145 shares at $68.70 per share for a total outlay of $9,940. If I sold VAS on 1 January 2024, I would have received back $13,030. During that period, I would have also received $6,664 in trust distributions that were 24% franked. Now, if we compare IVV with VAS side by side, we can clearly see that IVV performed exceptionally well with a 211% return on investment versus 86% for VAS. IVV's outperformance is mostly due to the underlying investments performing very well in this period, whereas Australian shares held within VAS were not as lucky, although they did still perform quite well. However, if we take a closer look, we can still see which is more tax efficient by looking at the effective tax rate as a percentage of the actual return on investment. Okay, here we can see that IVV has a total return on investment before tax of $25,713, which is for both dividends and capital gains. The total tax paid over 10 years was $4,639. If we divide the $4,639 by $25,713, the effective tax rate was 18%. Considering the constant tax rate we have used is 34.5%, having an effective tax rate of 18% is very good and clearly benefiting from the CGT discount of 50%. Now looking at VAS, the total return for this period is much lower at $9,733, while the total tax paid on the dividends for the past 10 years and capital gains tax on the sale is only $1,168. If we again divide the total tax of $1,168 by the return of $9,733, the effective tax rate is only 12%. This result for VAS is again because of the franking credits having reduced the tax payable to almost nil, while the capital gains tax was low simply because the capital gain was low. So VAS was more tax efficient as a percent, but with IVV you would have paid more tax, but made a higher return in cash overall. So does tax efficiency really matter if a less tax efficient investment outperforms? That's a question for you to think about when you're deciding what to invest in. The key takeaways for tax efficient investing is 1. Foreign dividends or distributions from global investments are not tax efficient as a strategy, as there are no franking credits to reduce your annual tax bill. So this type of income is taxed at your top marginal tax rate, and you'll get a tax bill when you lodge your tax return. 2. Franked dividends paid by Australian shares and ETF are tax efficient as the franking credits can be used to offset any Australian tax payable. However, if you are on a marginal tax bracket of more than 30%, you will need to pay extra tax to cover the difference in tax rate. As the average Australian salary is less than $130,000, the 34.5% tax rate will not apply for some time. Instead, a lower tax rate will apply that is less than the 30% tax rate paid by companies who pay franked dividends. This will mean many Australians that receive franked dividends will either pay no extra tax or will receive a refund of franking credits in cash. If you have other tax to pay, the franking credits will be used to pay this tax first before you receive a tax refund in cash. Either way, franking credits are very tax efficient. 3. Investing in high growth investments usually means you receive lower to no dividends or distributions, meaning you have lower annual tax bills from your investments. This is important to note while you're working and earning a salary or wage that is growing, as any dividends or distributions are taxed at your top marginal tax rate. This is important for taxpayers that earn more than $130,000 in salary annually. 4. The capital gains tax you pay when you sell your investment can be reduced by 50% if you simply wait 12 months and are an Australian tax resident. This is because the Australian tax rules has a rule called the 50% CGT discount that applies only to Australian tax residents who own investments for longer than 12 months. This makes long-term investing very tax efficient. 5. Capital gains tax will apply to all capital gains, which is a tax paid as a one lump sum in the year that you sold the investment. This means that capital gains tax can be deferred for many years when you don't sell the investment. The longer you defer selling your investment, the more your investment returns compound. Also, if you invest in shares or units, you don't need to sell the entire investment when you need to convert capital gains into cash to live off. This is because shares and units can be sold in smaller parcels, while you let the rest of the shares stay invested to earn more returns. In contrast, if you own direct real estate, you must sell all of the property and pay capital gains instead on the total capital gain. This is important for long-term tax efficiency if you intend on living off the capital gains of your investments instead of the income it distributes annually. Deferring capital gains into the future means you could pay lower capital gains tax at a lower marginal tax rate, especially if you wait for when you are on a lower marginal tax bracket, such as when you stop working and you are not earning a salary or wage. You may find one of these videos on your screen helpful to watch next. Thanks for watching. See you next time.